Hello, hello, hello. We're getting started on this Stock Trading 101. I guess this is the third installment now, where we're going to be discussing candlesticks, support and resistance, and we're also going to be discussing kind of like the intro to patterns. Actually, I got to turn on my Instagram live here too, so I can kind of funnel people over here from my massive Instagram following of 600 folks that I argue with more than anything. Add to your story, go live. Checking connection, bam. So I am now live on Instagram and Facebook and YouTube, but different platforms. So you might see me kind of go between the two. Hi, Suzette, how are you? Thank you for joining us. I'm just gonna wait like maybe 2 more minutes for everybody to get like their notifications. If you're just tuning in, I am going to be covering stocks, candles, the support and resistance, or the concept of support and resistance, and the introduction to chart patterns and how to interpret them. At this point, I've already gave an overview of how the stock market functions. I also gave an overview of the trading platform that I use. And now we're going to get into how you should be configuring or actually interpreting the data that's on your trading platform so that you can make the best possible decisions when it comes to entering and exiting your trades, okay? One of the things that I haven't covered yet, which I think is probably the most important piece of stock trading, is the risk management. And hey, Ben, how are you? I got a couple people joining me on Instagram. Just to let you guys on Instagram know, I am doing the same stream over on YouTube. And on YouTube, I'm able to actually share my screen so that you can follow along. If not, you're just going to be seeing me talk here. So I'm just using this feed to kind of route people away from Instagram so that we're on a platform where we could screen share and you could ask questions and everybody's in the same place. So sorry about that. Hydrate. Maybe I'll be hydrating with some wine while we go through this, but we'll see. What else is there? Okay, so I think enough time has passed. Ant, what's up? Suzette, I think we covered it. All right, so let's get into it. So first and foremost, I hope all of you guys have already downloaded ThinkorSwim. ThinkorSwim is the trading platform that I prefer because it gives really good, I guess, charting. And it gives you all the information that you really need, especially if you're going to be trading on a swing basis. I think for real scalp trading intraday, ThinkorSwim may not be the best platform because it is a little slower than some of the other platforms that I've used. But for the sake of this course, I'm really going to be covering swing trading where you're in positions for a few days to a few weeks. So ThinkorSwim is actually perfect for that. Actually, when I was day trading, I used to also have on one of my screens my ThinkorSwim charts because I preferred those charts over the Lightspeed trading charts because Lightspeed's charts are trash. And then if you pay for just a charting service on its own, they can sometimes charge you, 10 to even $100 a month, depending on which platform you use. So ThinkorSwim is actually preferred for me for those reasons. So I'm going to be setting up my screen share now. Let me just make sure I block out my account number. Sorry, I don't trust you guys. Yeah, I'm not putting my account number out there. All right, so let me just do my screen share here. Application window, ThinkorSwim, bingo. So right now, I'm actually gonna take my face off of the camera just so we have a larger screen to look at. And I'm gonna do my best to keep this strictly to an hour's time. So by 8:45, I'm going to conclude the lesson, and wherever we end, we're just going to pick up for the next one, because this bit of the education's it is a lot of information. So we're definitely not going to get through all the chart patterns and the interpretations of them. I think as I go through candles, I'll break for maybe 5 minutes for some quick questions on candlesticks. And then we'll go into support and resistance at 5 minutes for questions. And then again, probably I'll do one chart pattern, and then we can go into like the last 15 minutes of just questions, any questions anybody has. And that will be the format. Alrighty. So I'm also going to go between. I'm also going to be going between the two layouts like this. What's going on here? Do you see my my charts? Let's see, or did it go black? Let me reopen this again. Oh, come on. StreamYard is now being silly that it's not sharing my screen. Technology always lets me down. Hey guys, I'm over there on Instagram. I will be actually broadcasting this on YouTube. So if you want to watch along with what this charts look like, then that would be great. So even me talking has gone black. Everything has gone black, or can you still see me on YouTube? So let me know if it's still black. Okay, you see me. Okay, and let me share screen again. Huh. Very, very strange. That sucks. So I'm gonna share my entire screen here and swing over to ThinkorSwim, and you guys should see my screen. I hope so. Yeah, you should see it, because if you're seeing me and you see this, then we're in business. I'll periodically go between the screen share and not screen sharing, just so I could kind of check in with the notes or what people are saying. So right now you should see my screen. Let me just actually have you guys confirm that. Okay. All right. So you guys definitely see my screen. You should see my screen. I see it on StreamYard, so I think you guys should see it just fine. All right. So in the previous lesson, we set up our ThinkorSwim so that it presents this way, and this is the way that I like to see my screen. So if you guys ever message me or you're showing me charts, if we configure our screens the same exact way, you'll be able to, or I'll be able to quickly see exactly what's going on and make my interpretation of what's happening. The previous lesson covers this, and you'll see exactly how I got the background to be white, what these lines are as far as moving averages, why those moving averages are being utilized, etc. So the very first thing that I want to get into is a lesson that I actually took from Oliver Velez. He's one of the guys that I learned how to trade from, because he has a really good book called Tools and Tactics for the Master Day Trader, which really focuses on managing risk and journaling, which I think is very important for when you're trading. You need to be able to analyze what you're doing and analyze your behavior and really start to eliminate all the behaviors that are negative out of your trading program or your trading plan, so that all you're left with are the trades that are the highest probability for you. All right, not everybody's strategy is going to work for you. You eventually have to develop your own. So it's important that you journal. But Oliver Velez does a lot of teaching and a lot of education. And one of the lessons that he teaches is called the elephant walk or the elephant bar, or he has, they're kind of titled a few different ways, but it does such a good job at explaining how to interpret candlesticks on your chart. So for the sake of making this easy to see, we're going to zoom in to one of these bars so that I can more or less explain what is within a bar, okay? So this chunky part of the bar, the fat part, we could call this fat part the body. This represents the open, and if it's a green bar, that means that the stock opened at a certain price and closed higher. So there was a green day, a positive day, money in the bank. The skinny part, or the stick, or the wick, however you want to describe it, the wick of the candle is the range that it traded in within that day, okay? The reason why you want to know where a stock opened and closed, plus the range of the day, it gives you the full picture of what happened during that day, all right? And there's certain things that happen around opens, closes, highs, and lows of each and every day that are important. So being able to demonstrate that graphically will help you make decisions. All right. So this is what you would consider, a standard bar. There's either an open and there's definitely going to be an open and a close, and there should be a typical range for the day. Now, this red bar is a day where the stock closed lower than it opened. You see, from the previous day to this day, it actually opened higher, right? Which is a sign of strength with it from day to day. But for whatever reason, the stock price retreated and closed lower than the previous day, and also closed lower than the open. So you have a red body, and the thick part represents the open and close, and then the tails or the wicks represent the range beyond that is traded. Everybody that's on Instagram, please follow me on YouTube so that you're able to actually see the screen that I'm on. I'm sorry to do this to you guys, but that's just the way it is. All right, so that's your typical range. All right, now the standard bar is going to look like these bars represented: open, close, and a range. But there's 3 particular bars that you should be paying very, very close attention to whenever you see them, regardless of the time frame that we're in. Since we are swing trading, we're typically looking at 3 time ranges, all right? Predominantly the daily chart. Then we're looking at weekly charts, which is the next time frame out that I have my system configured to. And then the smaller time frame that we look to is also the hourly chart. These candlesticks are going to apply in all time ranges, and the thinking behind interpreting charts and technical analysis applies to all time ranges. The only difference is that depending on the time range, your data is going to be the data and the pattern is going to be more reliable and predictable, okay? Obviously, the data within a 1-minute bar represents 1 minute of time. So how much emphasis could you place on that 1 minute versus a 1 week bar, which shows you the story of the stock's trading activity for an entire week? More data points, it's a richer set of data. All right. But the bars that I want to talk to you about today are 3 specific types of bars, and I'm going to identify those types of bars on charts for stocks that I'm currently in. So here we have what's considered an elephant bar, okay? The reason it's an elephant bar is because it pretty much opened and traded aggressively for an above average range for the day and closed at or near highs. All right. On top of that, it occurred on abnormally high value. So let's zoom out again and let's take a look at this particular day. On this day, June 8th, this stock opened up at 36.57. And if I click on ThinkorSwim and follow it up, and it closed at just about 41.23. If you highlight the bar itself, come on. If you highlight the bar itself, you'll see all the information at the top, that the open was 36.69, the high of the day was 41.39, and the close of the day was 41.04. So it closed 35 cents from its high of the day, okay? And within that entire day, its range was 11%, right? So 11% stock movement in one particular day. And it did so on above average volume, okay? Now this represents the amount of shares that were transferred within the day. And it was about 3.3 million shares. Its average day seems to be closer to about 2 or even a little less than 2, with a few days being very high volume days, especially these earning days. This is what this blue light bulb represents, is that the company announced earnings. On earning days, there's always going to be increased volume, all right? So those aren't quite elephant days. Hey guys, just make sure you swing on over to ENTP Live on YouTube, because I'm doing this live there as well. And we're definitely covering things, visualizing my screen. All right, so aside from that, aside from earnings, any day that you see above average, heavy volume, above average, that really represents institutional activity. And by institutions, I mean hedge funds, pension funds, and all sorts of funds that are allocating, mutual funds that are allocating large amounts of money into a particular stock symbol, all right? There's no way for them to, well, they can hide it, but typically there's no way for them to hide that share activity, and that share activity registers. And usually when there's a big elephant bar, that is a major player taking a major stake, regardless of price, into a particular stock. So let's just kind of put this into perspective. Let's just say you're a portfolio manager that's responsible for managing $50 billion. And your company's rules are that you can't have more than 20% of your pool of money invested into any particular deal. And you can't have less than 10% in any particular deal, because it's just too small of an allocation, okay? So that means that he or she is gonna have to allocate $5 to $10 million at any given time into one particular investment idea, right? That may take place over time, or it may take place, in a snap, because they decided that from $36 to $40, this stock is a buy in my eyes. So they just keep refreshing their orders and gobbling up all those shares, okay? Obviously, they're going to want to gobble up the shares for as little as possible. But if there's pressure and added pressure, other investors purchasing that stock, ultimately that increased demand is going to drive the stock price up. So when you see an elephant bar like this, that's 2, 3, 4 times larger than the average bar, you see the average range might be about $2. This one is nearly $5, okay? So when you see that it's 2, 3, 4 times the average range of a daily bar, pay attention to that. It opens and closes near highs, okay? That the range of the bar is, like the body of the bar is the entire bar, and that it occurs on high volume. The thing that you need to take away from that is that bar represents heavy institutional involvement. And as a trader, you want to kind of piggyback off of the resources that that institution has. They have more analysts, they have more research going on. So when they're making a decision to invest heavily, it's for typically a good reason, right? It's not some random guy buying some stocks. It's somebody who's making a sophisticated choice. So, it's no different than stores that open up next to the leader in the space. Like if you follow McDonald's into a market, or if you follow CVS into a market, you already know that they've done a certain amount of research on that corner or on that street to know that it's a high traffic street. So if they're willing to invest there, you should probably invest there too. So that's kind of the logic there. The other bar that I want to highlight looks like this, okay? This bar, which is like a plus sign, all right? Now, this bar, I call them Doji Bars, or they're kind of like flat bars. They represent almost a stalemate in supply and demand for a particular stock. Now, the only reason that this is important, or the only time that it really comes into play, and when I consider these bars as something special, is when they occur at the height of a move or the low of the move. So if a market has been trending up for a long time, like it has been, and enters into an area of what we're going to identify later as support or resistance, and there's a doji bar that occurs there on above average volume, I like significant volume, 2, 3, 4 times the daily average, after an extended move, I would look at that as being an indication that the trend is going to change. Why? There was heavy buying and heavy selling at this single price, meaning that there was a huge unloading of stocks. And usually when that happens, when there's that huge exchange and the price doesn't really go anywhere, you got to be careful, right? Especially after a long move, because it shows you that supply and demand have equalized. If you were in an uptrend for a long time and you go into a level of resistance or into a significant price, and there's all of a sudden a flux where there's equality between supply and demand, and the stock price doesn't move, that's meaning that the buy side desire and the sell side desire have now met. The only way a stock continues to go up in price is if the demand increases. So all of a sudden at this level, there's a huge surge in supply. That's usually the smart money, the sophisticated money getting out while everybody's getting excited at this uptrend, okay? Or the downtrend. So when this doji bar occurs at an area of supported resistance with high volume, counter where there should be a potential for a counter trend move, pay attention, and you can utilize this bar to make a decision, okay? The final bar that I want to discuss are topping tails and bottoming tails, all right? And for the sake of this conversation, we're going to use this bar as an example of a bottoming tail, all right? I'm going to try to find another one as we go through stocks today. But what happened on this day? This stock opened at 2309 and traded all the way down for a loss of 9%, okay? $2 or almost 10%. It traded downward, all right? And before the day closed, not only did this reverse itself, but it closed at or near highs, all right? That tells you that in the previous day was an elephant bar down day, okay? Large bar, large range, traded weak. The second day there was follow through, and that's one of the things that I guess I didn't mention, is these elephant bars tend to have follow through the next day, right? This stock followed through the next day with a loss of nearly 10% from its opening price, right? The other elephant bar that we saw had a follow through within 2 days, right? So once you see the elephant bar, there's some traders who will make that their only play, all right? They'll make it so that I look for elephant bars At the end of the day, they take the position, in favor of where that elephant bar closed. And the next day, they're looking to just, play the momentum and get a trade out of that. That's not my style, but I do use the elephant bars to pay attention. But if you just see in this example, you have an elephant down bar. The following day, it trades down another 10%, which is significant to make in one day. And then it reverses. All of a sudden, this huge supply that's been added to the market for the past 3 days gets overtaken by demand. And then what do you see happen? The momentum changes, right? Not only does the momentum change, so for the next 1, 2, 3 days, this stock makes new highs, but when it pulls back, it never pulls back below the price where this huge surge of buying activity took place, and then again continues to make a new high. So when you see these sort of bottoming tails or topping tails come into the marketplace after, again, a long move or a move into a moving average like this 21-day moving average or the 50-day moving average or something along those lines, you can kind of position yourself for a reversal in trend, okay? Or sometimes even a continuation in trend. So, right here, the trend started to be up. It's making higher highs and higher lows. It pulls into the 21-day moving average on high volume, reverses, and doesn't look back from this day. This was the last time it made a low, right? Within the, this is a lot of stocks, but in the past 4 months, that was its capitulation point, and it hasn't looked back. So if somebody used this particular day as a point of reference to enter this stock and say, you know what, I like how this stock is behaving. It was in an uptrend. It held its 21-day moving average on slightly above average volume, closed at highs, and they bought on this day. They could have used the low of this day as their stop and could have earned until a new low was had, and that hasn't happened yet. The stock has never made a new lower low in 4 months. As you can see, it's pivoting here. It just set a new low and it started to change direction. So it's important for you to look at those things. Same thing here, in a way. Into this area of support, which I will explain in a bit, it held, traded all the way down here, closed closer to the highs, and bounced for what was a 20% move in 2 weeks, okay? If you bought here and you placed your stop, your risk right here, you've been risking $1.45 to make $7.39 on trade, all right? And you see these sort of things, this sort of behavior repeat itself over and over and over again in the market, all right? So those are the 3 bars that you want to pay attention to. The elephant bar, that's a large range, right? Something like this, above average range, 2 to 3 times the average daily range or higher, and 2 to 3 times the average daily value, okay? Another bar you want to pay attention to are these short range. This was is a long range doji, but something that probably has a shorter range and the plus kind of a plus look to it. That is supply and demand are at a stalemate. Those are important at the highs or lows of remove, and then the bottoming tail or topping tail. For the sake of showing you what a topping tail may look like, this is the reverse, where the tail's on top and the stock closes at or below its opening point, right? So it traded all the way up here, was a green day, and got slammed back down and was showing some weakness. This was part of a longer term move, like the move that we're in now. If this were to happen today, where we traded, made, significant new highs above all-time highs, and got slammed back down on high volume like that, I would immediately, I'm already short the market, but I would immediately be short the overall market because of that activity. So I'm going to go to your questions now, if there's any questions pending. To stream. Perfect. Are there any questions so far on the candle descriptions that I went over? I'm going to give like a minute or so for questions to come in, and then I'm going to move into the next point. And if you guys are curious as to that, there's like, I think it's about an hour and a half of tutorial on just the bars and the significance of those bars by Oliver Velez. I can share that link below so that you could get an elongated explanation of the very same thing. I really think it's a good resource for you guys just to understand how the bars work, who invented the bars, how they are used day to day. I think it's a really good resource. So I'm going to just wait another 30 seconds, and then we're going to move on to support and resistance. Yep, I will. I'm going to put it, actually, you know what? Let me do that now. I'm going to share part 1, and then you could copy this and follow along, okay? This is an old video. This is from back in the days, but the rules are still the same. Nothing has changed in how you interpret a bar, okay? It's just a graphical representation of the trading activity for that day. StreamYard. So that's the link right there. And you guys could watch that in detail. I think he does 2 versions, one in London, one in Dallas. Same information. Really good. I think it's definitely the way that you should take a deeper dive into this concept. All right. So back to my screen share. And back to ThinkorSwim. All right. So let's talk about support and resistance. All right. Support and resistance is going to be probably one of the most important things that you need to understand about price action and technical analysis, because it's something that repeats itself over and over and over again. All right. It repeats itself in the stock patterns and in everything. Oil prices, gold prices, currency, you name it. Patterns repeat themselves over and over again, and support and resistance repeats itself over and over again. All right. So this stock, XP, is a stock that I'm trading, and I'm trading it in this range. The reason why I like this stock's behavior is because it's had a powerful up move, right, over the past 4 months, and is now trading in a well-defined range. All right. And as you can see, the height of this range, it starts on this first pivot day, okay? So we're in an uptrend. Stock hasn't really retreated at all, right? It has no pullback in all of this time. And it finally has a reversal of trend. And where does it reverse to? The 21-day moving average, okay? Then it pivots and trades back to the same resistance area of around $50. And stocks have a tendency to do that. And it's not the stocks, but the people who are trading the stocks have a tendency to do that. When a stock is approaching all-time highs, approaching previous highs, and approaching an even number, $50, $75, $100, there tends to be resistance. Psychologically, those even numbers are what people use as their point of reference when they're setting their target. Like, hey, you know what? When the stock gets to $50, I'm going to sell. Or when the stock hits 100, I'm going to sell. So you tend to see stocks stall at numbers like that, $50, $100, $200, $500, $1,000, numbers that psychologically are even and stick with people. Sometimes it's 10, 15, 20, 25, depending on the value of the stock. So this came all the way to $50, pretty much tagged it, 49.78, retreated, right? So a pivot point is just a point of inflection, a change in market trend, right? Or a change in trend. When it's more than one pivot point, you can now say support or resistance has been clearly established, and you could draw a trend line between those 2 points. When it did come back to $50, it came back on a 22% move, which is pretty substantial, okay? So you can't expect the stock to go into resistance after going up 22% and just rip through it, right? Most likely not going to happen. That's like inhaling infinitely, right? The market breathes. It's going to expand and contract, right? That's just the way it is. You can't just rip forever. Even Amazon, even Apple doesn't just go straight up. And the longer a stock goes straight up, the sooner you know that it's going to be going in the opposite direction, all right? So this stock traded up to $50 and some odd cents, 76 cents or 60 cents, and then retreated back to this same pivot area, right? So it has 2 points of resistance, but now it's established 2 points of support, okay? It trades all the way back up here. I took this trade a few weeks back in XP from here to about here, right? As we were starting to approach resistance, I sold ahead of that resistance, all right? So we went from here all the way back to 50, peekaboo through 50 again, closed, started to retreat, had this aggressive move on earnings day to make new highs, and then this thing pulled back and started to collapse, all right? Now, where did it pull back to and where is it stalling? Ahead of this newly established support and around this 50-day moving average. Now remember, the 50-day moving average represents the stock's average price for the quarter, okay? This is a point of reference for traders who are trying to determine what is fair market value for this stock. The fair market value for this stock is this 50-day moving average because that is the quarterly average price, right? If this is what the stock has been trading at on average for the past 3 months, guess what it's worth? Around this number. So a lot of traders will get involved at the 50-day or at the 21-day, all right? 21-day is 1 month of trading. 50-day is a quarter. 200-day is, why is my 200-day not here? Okay, yeah, because the stock is too young. It still hasn't had 200 days of trading yet for a 200-day moving average to come in. This is a early addition. This is an IPO stock that's actually behaving really well. I would imagine it has some promise with this sort of behavior this early on in its life. All right. So I hope you guys can clearly see what I mean by support and resistance. Let's take a look at the S&P 500, right? This is the S&P 500 futures. Before the coronavirus collapsed, the S&P 500 had made all-time highs at 3397.5, right? That's the high print. And then the market crashed, right? As of today, guess where we are? This was today's trading activity. And the market traded to 33.95 and 75 cents, okay? Now, we are in a clearly defined uptrend, but this uptrend has been insane considering the economic conditions, considering everything having to do with coronavirus. But we're now into pre-coronavirus territory on S&P 500. On the NASDAQ, we've already peaked beyond that. So coming into this day, look at how many updates we've had. There's been no real pullback. So as I mentioned before, do you really expect the markets to just rip through all-time highs and just tear after it's been going up for 3-4 weeks straight or for 2 months straight? No, it's going to breathe again. All right. So today I bought quite a few. I think I bought 500 contracts short on the market, option contracts, because I'm anticipating a reversion to the 21-day or even a reversion to this area here, this pivot day, which was clearly a point of difficulty for the market because it failed here, failed again, and then consolidated here and teeter-tottered in this level. So I do believe that we will retrace back down to this area within the next few weeks, maybe after Labor Day, because trading activity is low. But if we start to get some downside elephant bars like this in the next few days, and we break this trend line that's been established, 1 point, 2 points. If this trend line doesn't hold, we're seeing the 50-day moving average or somewhere in this area like here. I'll probably start to get out just in case it stalls ahead of the 50-day, but I wouldn't be surprised if we tag it to the T. All right. So as you can see, all-time highs being retested becomes resistance. This pivot area being retested becomes resistance. All right. There are traders who just wait, literally just wait for this day to happen and take a short position because they're clear that there's resistance here, and will trade that for a day or for 2 days or whatever their strategy is. So let's look at some other stocks. 1, 2, 3 days establishing the same price level. I drew in a trend line for support. Also, it coincides with this 77.50 price. It bounced here, traded back, it's holding. I like this level as a clear line of support. And we have this rising 21-day moving average. I'm in this stock. I have 500 shares, and I'm not risking much. I'm only risking, what is that? 2% on, a $40,000 position. So I'm risking, about 700, 800 bucks on this trade, right? And I'm anticipating that it makes new highs and actually breaks above that. So I'm risking 2% to 3% to make like 10 to 15% on this trade. But I just wanted to show you that, look, the high here, resistance. Again, Peekaboo closes below that line. That resistance is still holding. So that's my trend line. Let's look at another stock. Again, previous high, 110.17. The next day, trades almost there, comes back to 110. Okay, this was on Monday, I believe. Yeah, Monday. I bought it on Friday. On Monday, it traded up to 110. I should have taken some shares off the table at this point, but I didn't. All right. I guess greed took over that day. And plus, I wasn't like staring at my screen. Sometimes these moves happen in the middle of the day and I don't have an order out, or I'm still trying to play for the higher move. But if you see, this stock, Ali, was showing clear support right around this 150 cent area, and clear resistance is now being established at this 110 level. Okay. The thing about support and resistance is when support doesn't hold, you get pretty significant downside moves, right? Because the people who are buying that support level are also betting on the fact that if it gets below this point, they're clear that the demand has now exceeded, the supply has now exceeded the demand, and they start to exit their positions. not only am I using these areas of support and resistance as targets, as stops, a lot of traders are. So when the stock fails, there's all of a sudden all these stops being triggered, all these traders being triggered to exit the position. Or they're triggering to add to the position when the demand or the supply has been exhausted, right? So there's people who trade breakouts. I don't really like to trade breakouts because breakouts tend to pull back and hurt you a bit. Let me see if I can find something else that's clear support and resistance to drive that point home. Okay, let me show you something else. PFSI. So here, this stock, which I traded a few weeks back and made some money on this move over here, I got involved down here on support and benefited from this breakout, okay? Now, this was showing clear resistance at this level here, right, that I drew in. And another thing that happens is when resistance gets broken, it often becomes support, or actually it becomes support when it's retested. So you see this stock got above $43, traded a little bit above it, but when it pulled back, it held this level and took off ever since. When this retreats again, it would most likely hold for a day or two, or even a few hours, or bounce off of this area of newly established support, okay? This was resistance. That resistance has been broken and confirmed, and now becomes support, all right, on the reverse of that stock move. So that pretty much wraps it up for support and resistance. So I'm gonna just kind of pause here for spastic. I'm gonna pause here. I'm gonna pause here for some questions. Talia Bella, options. What about options? Ant N. So that means the market is going to decrease again due to resistance. Yes. So what I believe happens, what I believe will happen is that the market. Oh yes, it's on 720p. I'm sorry about that, but you can follow along on your own. Looking at the tables again, they'll be more clear that way. I'm sorry about that. I wasn't thinking about that, but my apologies. But as far as the question regarding is the market going to go down, I believe the market will correct. Most corrections are 15 to 20%. That's like a safe, normal correction in a market. If we get a 15% pullback, it may be a buying opportunity. If support starts to be reestablished, if new patterns start to be established, if we pull back into a moving average. But the short-term response, you should expect a pullback. The pullback might be 4 hours and then 4 days of just drifting sideways or consolidation. And when you see the market kind of consolidate near highs, that is actually a good sign, because that means that the supply and demand is being exchanged at that level and not an overwhelming amount of supply has hit the market. And since an overwhelming supply, even if there was an overwhelming supply, there was also an overwhelming demand that kept it right there. So the market traded sideways, almost like a bunch of Doji bars trading sideways. And once that supply is exhausted and the demand is still there, demand takes over and stock prices start to trickle up again, right? So now that we're into resistance, I've been kind of prude about what sort of positions I enter. Definitely not buying breakouts. Definitely trying to get the best prices possible. And I've been a little more likely to take 5% moves, 7% moves. I usually like to take 10% or more, but I'm now taking 5% moves on $20,000, $40,000 position. So that's like $1,000 profit or $2,000 profit, rather than holding for like $4,000 to $8,000 profit ranges, because I know that we're into resistance. So it's not like a rule that if once you hit resistance, you're going to collapse. No. It's not like that. That area of resistance should get you to think critically. All right. That should be an area where you decide potentially to take profits, or an area where you could take a very short-term trade for a few minutes to hours to even a few days, because you might have a 2 or 3 day pullback from that level. You might want to take profits at that level, because if there's a 2 to 3 day pullback, you're now giving up some profits. So it's kind of in your best interest to take profits there, if that makes sense, right? So we're moving into resistance. Market's probably going to pull back. I should probably start taking profits. I probably shouldn't enter any new aggressive long trades, okay? When that market does pull back, what you're going to want to look for is relevant strength, okay? You're going to want to see this stock compared to its sector, compared to the general market, only pulled in 5%, while the market pulled in 20%, okay? That means that new supply didn't come in, that the investors, the big boys, are still interested in keeping their money there. So when the market does turn around, which ones do you think get more demand? The ones that get more demand are obviously the ones that showed more institutional interest and resiliency during economic collapses. You can look at every stock that performed pretty well while the market crashed. Let's just say the market crashed 30%, whatever it was, and those stocks only came in 10% or didn't even really budge. There's not many stocks that didn't budge, but let's just say it didn't budge. They were the ones that were off to the races when the market turned around, right, and led the way and making new highs way before the market has. You know, look at let's just look at this PFSI, right? It had a pretty significant pullback, but compared to the market is just retesting highs today, and this was retesting its highs back in June. So its recovery was much faster. Then it consolidated in this range above this pivot level. And you see these areas of resistance come into play over and over again. Oh, I'm not sharing my screen. Duh. So this PFSI compared to the market crashed at the same time, everything got hit, right? When it rebounded into new highs for the year on June 16th, and the market on June 16th was actually pulling back, okay? So, and even in this micro session, when the market pulled back, this thing stayed solid within the high of its range, above its 52-week high. This is what made this a really interesting buy for me, and why I was getting involved down here. Because when I saw the market pulling in to this 50-day moving average, I knew there would be a bounce at around the same time. So like here on the 26th, we're down here as it's holding, and the market starts to turn around. I'm more confident that this is going to turn around and go too. I didn't get this whole move. I wish I did. But for me, grabbing my 10% from here, I got out right around here because I was in from around $40. So these are the sort of things that you want to think about. It's like, well, now that we're into resistance, right? Look at the sell-off in this stock. We've been trickling up into this resistance for the past few days, and now the stock is selling off after a massive move. Why? It would be dumb for you not to take profits before the market starts to pull in if you're a trader, right? If you're a long-term investor, what happens from week to week, month to month, sometimes doesn't matter to you. For me, these sort of things matter because I'm only trying to be in a stock for like 3 days, 5 days, maybe 2 or 3 weeks. If it's like not so volatile, I'm really committed to the idea, I'm going to hold it. But, if it's not that, days to weeks, really days. I don't even like being in stocks for weeks. But that pretty much establishes the support and resistance concept. And I think as far as a stock pattern is concerned, one stock pattern I'm going to go over is going to be the bull flag. Okay. The bull flag exists when there's a powerful move up, right? See, in these 2 days, this stock has gone up 100%. And then for the next few days, it consolidated and started to form a clear level. Now, I didn't take this trade, but you could have gotten involved around here, risking 15 cents and trying to hold this to retest highs. Because if you did, you would stand to make 75 cents a share, right? Or 15% on this $4 share, just trading and holding it within this range, okay? Now, this is a bull flag. This is something that I always look for as I'm scrolling through stocks every single day. This also could be interpreted as a bull flag, especially if you look at it on a different time frame. On the weekly time frame, you have this elephant bar and this higher consolidation for 3 weeks. I'm in this stock. I like it. I'm in it at where this green dotted line is, and I have my stop down here just because it's really low risk. So I want to give it some breathing room, but I might move up my stop to about below the low of this range just because I see the market's acting a little weak. So there's no if this doesn't hold, it's most likely trading lower. All right, but it's the same concept. Large move, high volume, consolidation, decreasing volume. I can expect this to turn around and break out again for another move. Okay. The next lesson, I'm going to be covering more of the patterns. Okay. So not only are we looking for patterns, but we're looking for that support and resist, because the concept of support and resistance helps you understand how patterns are being built. And then once you train your eye to really understand support and resistance, and you train your mind to understand what happens at support and resistance, then you couple that support and resistance with stock patterns that are proven to have a certain rate of performance, okay? A stock is either going to go up, down, or stay still on every given day, right? Where it doesn't change price. Most likely it's going up and down to some extent. So you're going to be right 50% of the time, regardless of what you do. For how much are you going to be right or how much you're going to lose, that's what you have to potentially manage. But certain stock patterns have like an 80% rate of continuation for a certain amount, right? So like a bull flag has a rate of performance that's above 50%, and it usually moves 50% to 100% of the initial move. So I wouldn't be surprised of this ADMS traded all the way up to the $6 mark after it gets out of this range, right? That's why I was interested in it, and that's what I was looking for, because its move had been from $2 to $5, or from $2.50 to $5. And then if it were to play out that again at 50%, then it's going to move potentially another $1.25, which takes us to this $6 resistance area, right? Clearly there's resistance here at this $6 price. So, the measured move and the prediction would be there's going to be some continuation here, which is already showing signs that it wants to continue because it's consolidating near the upper third of this move, and it's starting to make higher lows, and it's kind of trading into this area where it's sold off. And if this holds up, it should continue for a larger move, especially if you got involved down here. I didn't, unfortunately, but that's the sort of thing that I'm looking at when I'm making my decisions as to what stocks am I going to involve myself in. All right. I'm going to just switch over to question mode at this point. I wasn't on my screen. Sorry about that, guys. It's just how this thing has me set up, unfortunately. So I'm going to just switch over to questions at this point, and then we're going to probably cap out in 10 minutes. All right. So Ant was like, is the market? No, I answered that question. Is the market going to decrease because we're into resistance? Short term, yes. And to get Ben, is there any signal as the 1% rule in real estate? Well, there's a lot of different signals and a lot of different rules. There's Fibonacci retracements. There's like the measured moves outside of known bases, which are patterns. My rule of thumb is your risk to reward should be at least 2 to 1. Okay, so your reward should be 2 to every 1, right? So if you're willing to lose $1 per share, you should be looking to make $2 per share or more. Because even if you're correct half of the time, and you control those parameters, you'll be net positive. All right. So the larger your risk to reward range is, the better it is for you. So that's kind of the way that I look at it. My rules are that I don't have more than 20%, 25% of my capital allocated into one stock at any given time. And I don't risk more than 5% of that 20% in a particular trade. All right. So if I was so I keep my account at around $160,000, and that gives me $320,000 buying power. All right. And more than that if I'm day trading. So my positions, I don't really want them to be more than $40,000, $50,000 per position. All right. So if it's an $80 stock, I'm buying 500 shares. All right, for $40,000. And I don't want to risk more than $2,000 on any particular trade. And I'm usually looking to make $5,000 to $8,000 on that particular trade. So if I'm right half of the time, I'm going to be up 5%, right? If some of the trades work out for 15, 20%, when you get some really good movement, those really make the difference. Those are the months that inch you up ahead. But if you continue to control the risk and you keep it at minimum at 2 to 1, when you have those 4 to 1 wins, or you have those 8 to 1 wins, those really offset your quarter, offset your year, right? And offset a whole bunch of losses. You're gonna lose money on trades, right? There's nothing that you can do to avoid that. You're not gonna be a winner on every stock that you touch. But what you absolutely can control is how much you're risking, okay? And you can control when you buy and when you sell. So that's probably the most fundamental thing is your risk management. But as a rule of thumb, at least 2 to 1 risk to reward, and don't overcommit yourself. Some people would disagree with me, but I don't overcommit myself to one symbol. Because if something horrible happens, like the FDA pulls the drug, they're leading the top selling drug, that stock is going to crumble overnight, and you're not going to be able to even get out. You might take a 75% hit on a particular stock from one day to the next. And if your entire portfolio is invested in that one stock, you just lost 75% of your money in one day. Meanwhile, if 20% was exposed to your account and it lost 75% value, your overall account would have only had 15% loss, which is a whole lot better than 75%. Does that make any sense? So you kind of want to not put all your eggs in one basket, And if you do, you might want to insure your positions with some options. Okay, that's a whole nother topic. But if you're going to be taking that level of risk, then one way of mitigating your risk is to take option positions opposite your trade, where you have a contract to sell or buy at a specific price, so that you're somewhat insulated. Yeah, no, there's no risk, no reward. That's the damn truth. But you don't want to take that statement and like exaggerate it, where you're saying like, oh, the more risk I take on a particular trade, the more reward is there for me. No, you want to take as little risk as possible on a particular trade that has the highest chance of having a major move. Like that XP trade, the closer I could buy that stock to its support line, if I'm 5 cents away and I get it at 5 cents away from a breakdown, that's like the best position that I could be in, because I'm only risking 5 freaking cents to make $15, right? I'll take that 100 times of the day. The probability of you getting a retracement all day within 5%, its support line holding, and you being patient enough to do that and do that consistently is kind of low. So you start to kind of judge and say, all right, well, it's within 2%, it's within 3% of my stop or that support line. I'm comfortable buying here. If it trades lower, I might buy more, right? Because you might expose yourself to more shares because you're so close to the stop that even if you were to fail, it would still represent a small loss for you, right? But if it were to recover right away, you might sell some of that just to insulate your position and say, okay, well, I normally take a $40,000 position, but I so love this chart, I'm getting an opportunity to buy at a good price, I might double that. If I lose on that trade, I still only lost $200. So what? But if that day it has one of those reversal days, right? One of those bottoming tails on that day, I could close out the day with a nice bottoming tail where I made 4%, cut back to my $40,000 position, and then I know I have the freaking best price in the house, and I could hold that position. I already made money. Now I could just hold it for the true target. I don't even care what happens because I'm already in the money, right? So sometimes I'll play a position that way if I really, really love it, because I'll try to insulate myself by making early profits and then kind of carrying the trade for what I want. Or I'll sell half of my position at like 7%, 8% into resistance and hold the other half for what I think might be the next move of another 8% or 10%. That way I satisfy the need to kind of sell ahead of resistance and protect my investment. And then I also satisfy the greed where I'm like, yeah, this could be a really nice hit. Ben is asking, do you reverse search a company before investing? No. Most of the time, I'm making my decisions based on the chart. So most of what I trade is going to be the IBD 50. It's going to be what my trading group on Discord kind of throws out, which is bread and butter. So I have a watch list of that because we kind of have similar styles, or I'll add to my watch list of people who have similar styles. And then I look through the S&P 500 daily, and the S&P 500 are already stable, well-vetted stocks. So I look to the S&P 500 for stocks that are exhibiting the behavior that I like. So it's the IBD 50, my group list that I look at, and the S&P 500. And if I don't already know the symbol, and I say, okay, this company is I don't know, ExxonMobil, let's just say, right? I know ExxonMobil is oil and oil related. So I know that I'll know the industry. If I don't know the industry, then I might just do a quick Google finance search to see what sector they're in, so I can kind of compare how other stocks in that sector are doing, right? If it's if it's a stock that's in the mining, right, or the precious metals, I might, and gold is having a really big move. I might start looking at precious metals. I might look at the copper miners. I may look at the silver miners. I want to see, is the entire mining industry on fire? And if it is there any stock that's kind of lagging that hasn't gotten bought up yet that offers me a pattern, some support resistance lines, low risk? And since the entire sector is starting to really get its legs, I might get into something like that. Or if I'm in a stock and we're going into resistance in that particular stock, I might look at what the sector is doing. Are there leaders in the sector that have already exploded? Are the leaders already starting to pull back? Because if they are, like for example, Apple, Facebook, Google, Amazon are tech leaders. When they start to misbehave, they kind of pull down the entire tech industry. So I would say I only look at them if I'm trying to gauge relative strength to the market, relative strength to the industry, and kind of help me make a decision. My primary decision is made off of how that chart presents and my risk to reward on the visuals of that chart, the support resistance, where it is in reference to the moving averages, and the pattern that it's in, and what price can I potentially buy it. That's more important to me than what the company does. Ant N, what are your thoughts on new IPOs? Are they worth investing in? So in order for me to trade any particular stock, there has to be a pattern, right? I have to see something on the chart that makes me say, okay, I'm paying attention, right? So will I trade an IPO not on opening day? You're going to get crushed. Or you could, there's some people who trade well that way. I'm not like a intraday momentum trader. That's just not my strong suit. But if a stock is 4 months, 6 months old, recent IPO, exhibiting an awesome pattern, I would get involved in that, because IPO stocks, young stocks, tend to have the most outrageous moves. So a young stock showing a good pattern, markets in an uptrend or healthy, and I find an area in that pattern where I'm comfortable getting some size and allocating some money, then I'll do it. But just because it's an IPO doesn't make me say I need to get involved. I get involved when all of the data, which is on the chart, that's all statistical information of price, supply and demand, and activity. So when the data lines up for me, then I'll get involved, and that's it. There's nothing else that concerns me. Yeah, that's right, Bird. It either sets up or it doesn't, and what IETO2 is saying is, like, you have to look to the stock market. You have to look to the chart to give you the clues and give you all of the evidence of what makes this good or bad, right? And all of it is there to visualize. So, and you need to know what you interpret really well. So if it doesn't set up the way that you like it to, you shouldn't be getting involved, right? If the chart looks like, those meters, what are they called? I don't know, an EKG meter, right? If your chart looks like that, actually that would actually be a decent chart. But seismograph, right? If your chart looks like that and there's no clear pattern, there's no clear support or resistance, you shouldn't be trading that, right? Because there's no data for you to really position yourself against, right? Because you want to position yourself really between support and resistance, and evidence that price action is going to change, right, in the near term. You're going to be making your decisions off of that. So if you don't see a pattern, a particular setup that you're comfortable trading, don't engage it. Another question from Ant. Also, are you going to make a video on options trading? I ask in terms of doing options trading on one of the bigger tech companies, Apple, Amazon, Netflix, etc. I trade options, and I will trade options on higher price stocks to kind of preserve my buying power. But the rules are the same to me, right? So a $400 stock like Apple, right? Is Apple 400? What the hell is it trading at? I think it's at 400. Yeah, 460. So a $400 stock, right? If I want to be in a position at $40,000 to $50,000, then that means I could buy 100 shares of Apple. But if I'm still counting on the same rules that I want to make 10%, it doesn't matter if the stock is $400, $4,000. If it's $4,000, I'm looking for it to go from 4,000 to 440 or 4,400. If it's a $4 stock, I really don't like trading those cheap guys, but if it is, then I'm looking to be in there from $4 to $4.40 or higher. All right. So the only time that I will use an option is when I'm starting to kind of squeeze down on my buying power and I want to get involved in another stock. And I'll say, man, all right, I only got $5,000 of buying power left, and this chart looks freaking ridiculous. And I want to get involved, but $5,000 doesn't get me anything. I might take $5,000 in option contracts, and that will give me exposure to that stock symbol, and I'll benefit from the short-term price action on that. So I might make 75%, 50% on my contracts in 3 days, 4 days, but it's only on 5,000. So if I make 75% on a 5,000 position, that's still like $4,000, right? Or 3,500, which is in line with my average position win. So that's how I would use options. And I also use options when I'm trying to protect my position going into earnings. So if I have like a winning position and I'm hoping that earnings, kind of create a gap up situation where you have a significant price change from day to day, I'll buy options just so I don't play myself. And if there's a gap down, that I lose my money. So let's just say I bought a stock at $90, it's at $100, and it has earnings tomorrow. I'm hoping it gaps up to 110 or 115 or something like that, right? That would be fantastic. I might buy puts at $100 for the week. It might cost me $2 for the contract, but at least if there's a significant gap down, I still captured 98, the $8 move, rather than it being gap down and me being out of the money, because that put will come into effect and will balance me out. It cost me $2, but it saved me potentially more than 10. Yeah, so that's how I use options. I'll probably go into options trading later on in this series, because option trading isn't as clean as trading stocks, because you have the time value working against you, and the options don't necessarily, the option contract prices don't move in tandem, like directly with the market or with the stock symbol. So you might have a stock that might have moved $5 in the day, and the option contract price moved 50 cents for the day because of time and how far out it is, and are people buying that option, and has the supply and demand changed. But as you get closer and closer to expiration date, it starts to get a little more juicy, right? The further out you are, you don't get so much of a change. It's kind of weird. It's not, you're having to account for time, and also it's more volatile in the sense that you could lose 50% 2 days in a very normal pullback. So you have to kind of manage your risk a little different. Like I really don't like to take contracts that cost me more than like $6,000 for the contract, because if it pulls back and the stock falls apart and I take a $3,000 hit, I take a $3,000 hit. Or if I'm willing to hold it all the way to expiration date, then I don't want to lose more than what I paid for the contract. So I kind of try to keep my contract pricing equal to what my max loss would be on a regular stock position, right? Which kind of limits how much exposure I tend to take. So, that's intrinsic and extrinsic value. Yeah, Bird, I wish I could, I knew all the terminology, man. Sometimes I don't. And I don't claim to be like some sort of stock genius by any means. I just know what works for me. And people ask me, so I'm doing this series. Just even if you learned one thing, right? And that one thing is, when should I adjust my portfolio? When should I move my self-directed IRA from invested in the market to cash, or when should I move it from one stock to the next because major selling pressure has come in and this looks like the end of a rally? If you just learn that, and you don't necessarily learn how to trade and make income from trading, but you just learn how to manage your portfolio better, then I've done my job. I can only teach you what I like and some of the fundamentals, but when it comes to trading, you ultimately will develop your own style. And when you develop your own style, you need to master that style and own it and live by it. When the market is trading well, when the market's not. For the past 2 weeks, I feel like the market has been trading like crap for my style. I've been just back and forth. I'm getting some wins, I'm getting some losses, but I'm net flat, right? Some days I'm up 6, some days I'm down 5, some days I'm up 3, then I'm down 4. So I'm kind of like bouncing around in this range, but I'm not letting any position get out of control. And when the market conditions favor my style, then I'll have a 10% month, or I'll have, a 20% month where I'm up 30 grand, 40 grand or something like that, right? Like I think June, July, I was up about 35, 36,000. So, if I'm flat for August, all right, I'm flat. Or I lost 3,000. Okay, I lost 3,000. I already cashed out my July, June earnings, and I'm allocating that money for my next international investment. So I'm either copping some land down in Brazil, or I might pick up another property in Europe. And I'm debating that right now as to how am I going to allocate that. I might just turn around and, push that money into a US deal if that makes more sense. But that's kind of how I use my trading money. It's kind of like my play money to exercise some of my ideas, right? So I'll take stock profits and I might treat myself on something. It's kind of like my effort money. Or I'll say, hey, I've been thinking about starting this new business that I'm not going to raise money for because I think it's too risky or it's too weird. Then I'll say I'll take it out of my stock earnings and I'll invest it here. So that's kind of what I've been doing. I've never exercised an option in my life. I don't even know how. I don't even know what happens. Like, I don't know. I never get to that point where it's like, okay, yeah, I'm so in the money on this option that I'm going to convert it to stocks and I want to hold that stock for some time. I'm usually in my trades, Barrett, I'm in there for days, 3-4 days. Then I already start getting queasy. So I like my moves to happen right away. Or just kind of, if I get like a nice trickling straight up day by day, I'm up 2 points, no resistance in sight, I'll hold that. But once there's some like instability or I'm uncertain, I'm in there for 3 days, 4 days. If I have 7%, 4 days, I'm out. But I've never exercised an option, so I don't know what happens on that day. I would imagine that you would need to have the underlying capital requirement, or you might get a sort of margin call to satisfy it. but I don't know what happens. I don't know what triggers, and I'm not trying to find out randomly. Yeah. I'll take profits from the stock market, and I'll do things like treat myself. I'll do things like try other business ventures. Like, I would take money from the stock market and get a new Airbnb apartment, right? That Airbnb apartment might cost me 10,000, 7,000, whatever to set up, but I might make an extra 100% a year on that money, right? So, am I going to make 100% in the stock market? Most likely not. I might make 30%, 40% for the year, and that would be considered pretty solid for the year. So if I'm able to take part of those profits and reinvest into something that would make me 100, or that will make me more passive money, like pretty easy money, it's like, okay, this stock market earnings of $10,000, I put it into an Airbnb in the city in Manhattan. That Airbnb makes me $1,500 a month. That $1,500 a month pays for, insert whatever car you want for $1,500 a month. Yeah, my car payment's $300. So, if I wanted to put that money towards maybe my next aircraft finance or something like that, then that would make sense, because it's like, oh, this $10,000 payment pays my monthly note on my next plane, right? Now that $10,000 has me covered for the next 3 years, 5 years of making my plane payments. So I play with it that way, because then I feel like I'm somehow cheating, because I feel like I stole the money from the market, and then I took that money into the physical world, and it's now making me money again with things that are like tangible. So that's my opinion. All right, guys. I talk too damn much, so that's 30 minutes over time. Those of you who have enjoyed this session, please make sure you leave your thumbs up, share the video with people who you think would benefit from this. I didn't do my normal spiel in the beginning of this video as to what ENTP Life is all about, but it's my channel for business, real estate, and all the other things that I'm interested in. Stock trading is one of those things. And it also kind of satisfies the business side or finance related. I try to put out a video every week, sometimes 2 videos a week, depending on if I get bit by the creative bug to put out content. But if you feel that you have friends and family that can benefit from this, please make sure you show this video a little bit of love, and I'll just stand by for any last questions. And what I'm going to do is I'll add to the description, the books that you guys should be reading. How to Make Money in Stocks by William O'Neill. Tools and Tactics of the Master Day Trader. Even though I'm not teaching day trading here, I think it's a very important book that teaches you the psychology of the market, how to manage your personal psychology, how to manage your trading journal. So you definitely should check that out. And then I have, everything else that's in the description box. So you'll find that Oliver Velez video that I referenced earlier, the elephant walk, very useful tool for what we covered today. Next week, we're going to, not next week, next video, because I'm not going to promise that I'm doing this next week, probably in another 2 weeks. The next video will cover more of stock patterns, some of the rules associated with them, like as far as what you could expect as far as measured move, the logic behind some of my favorite stock patterns. And then I think once we're comfortable with the concepts, then I'm going to encourage you guys to move over to paper trading, so that our conversations, whether it's in the comment section or on Instagram, or if you guys joined the Discord group, that our conversations are really about stock activity, and that you're paper trading and experimenting with trading stocks. That's what's going to kind of refine your trader's identity. And when you feel that you have a good handle on putting out orders, interpreting the charts, interpreting the patterns, then I would encourage you to move over to real money. The jump from paper money to real money is different. I try to tell people to take their paper money seriously. Okay, treat the paper money how you're going to treat your real account. Don't take your paper money and say, all right, well, my strategy is going to be no more than 20% or 25% of my portfolio in, but you're taking, $200,000 of Netflix, and you held Netflix for, I don't know, 30 points, and you made a small killing, but meanwhile you don't have $200,000 to trade, and you're not going to do that in real life because the fluctuations are going to make you sick. So, if you're going to be starting a portfolio out with $10,000, then only expose yourself and manage your paper money account as if you only $10,000, so you can see what your performance is on that 10,000 and treat it that way. Don't one day say, all right, I'm losing money on my 10,000, and then I'm gonna buy some Amazon. I'm gonna make some money, and then you're lying to yourself that your trading activity is actually profitable. You want to treat the paper money like real money. So then we're going to go heavy into that. That's why we're going to be ongoing for weeks. And then at some point, you're going to make that jump to real money. And you should be at that. Once you make the jump to real money, everything changes. It took me about 4 years, 3 to 4 years to get consistent in what I liked. Okay. And then it takes a little bit longer to master that, right? You get consistent in what you like, and then you need to master that thing. So, the faster you can kind of target in on what's good for you, and the faster that you can control, the demons inside you, the faster you get to have the potential for success in the market. It's not, I always repeat, it's not for everybody, but what everybody should learn. All right. Awesome, man. You guys have yourselves a good night. Thank you all for joining me. Some of you guys are my buddies. Some of you are becoming friends. I wish I knew who you were, like Ant. I don't know you. You're very active here. I wish I could put a face to the name. Kareem Show and Tell, thanks for joining us. Galaxy Wave, buy gold stocks. I rarely do, because one thing that I do have biases, and gold never made sense to me. I can't eat gold. I don't know why people really value it. I know it has some high-tech electronic usages, but I just feel like, if the world implodes, I'd rather some pork bellies than gold. Casey, if you're still around, sorry about the pixels. And, Stefania, thanks for joining. Loris, thanks for joining. Suzette, always a pleasure seeing you pop up. All right, guys, and ladies and gentlemen, I would say, please, open learning, sign deals with other, I don't know, leading edge. All right. Anyway, sorry I got distracted by these comments, but thank you for joining me. You all have a good night. If you're going to be trading tomorrow, good luck. These next days are going to be a little funny. So just be careful out there if you're actively trading. And remember, stick to your risk management. The only thing you can control is when you pull the trigger to get out of a trade or get in a trade. So make sure those decisions are well calculated, and ensure your safety and ensure the safety of your money. All right, because when it's out of your account and you had a major down day, I've been there. It doesn't feel good. All right. So everybody have a good night. Take care. Bye-bye.